Welcome to the latest episode of Yahoo Finance's Opening Bid podcast. I'm Yahoo Finance's executive editor, Brian Sozzi. Now let's make some money and get a lot smarter. Here with me now is Bradesco's BBI new head of equity strategy, Ben Laidler. Ben, congrats on the new position. Good to see you, man.
Yeah, thanks for having me on.
So there's a lot to talk about, but I loved. And I think this is a pretty good starting point. I love this note that you sent over to the team ahead of this one. You noted that the election cycle is likely a volatility event, not a fundamental event. Talk to us a little bit about that, because from the vantage point here in the U.S., I know you're in the U.K., but from the vantage point in the U.S., I think investors are getting pretty worried about what they saw after that debate between former President Trump and current President Joe Biden. And it's not yet reflected in the market, that nervousness, and there's seems to be at least to me, a rising sense of uncertainty.
I think that's right. We've just had this gangbusters sort of first half rally, right? So I think we are set up for a little bit more volatility in the second half. And one of the key ingredients for that could be this early start of the US presidential cycle. The US is 65% of global market cap, so we can, complain about the French election surprise, the Indian election surprise, the Mexican election surprise, until we're blue in the face. But the granddaddy here is, November the 5th. And we're coming into this after this big rally with volatility, S&P volatility at, nearly record lows. Summer doldrums, potentially, seasonality. So I think we are set up for more volatility, but I don't think investors should necessarily worry too much about that. And I say this with a little bit of trepidation, right? Because, stock market forecasters are generally terrible at politics, so that's the health warning. But, these are the two best-known presidential candidates we've ever had, and neither of them are dealing with arguably the biggest political issue out there, or macro issue out there, which is this yawning deficit and these rising levels of debt. So. And I think, the one takeaway from the debate last week was the market has sort of made its peace with Donald Trump being the next president. We saw markets sort of edge up a little bit. We didn't see that volatility. So I say with a lot of trepidation that maybe this is a volatility event rather than a fundamental event. But, time will tell.
Ben, let me press you on that one. You have a former president, Donald Trump, who oversaw people storming the Capitol. So there's that, among many other problems that he's facing, various convictions, you name it. You have a current president in Joe Biden who went on primetime TV and couldn't put a couple sentences together. And there's real concern if he could just govern effectively for 4 more years. If I'm an investor, why not take my profits that I have today ahead of what appears to be just calamity at the end of this year?
I think investors have been a little bit more simplistic than that. I think investors are looking back to the first Trump presidency and thinking, that was fairly pro-business. I made a lot of money. Maybe we're going to get, a repeat of that. And, Joe Biden's the president today. And, the economy is going to grow 3% this quarter and inflation's come down and we're about to start cutting interest rates. So not everybody is obviously feeling that. But, the market is on track for the best year since 1995, which is 40 years ago. And we're on track to have the greatest number of all-time highs, since then. So, again, I think the glass is half full, not half empty. I do think there's going to be more volatility, but I think markets will get through this. I think the pillars of this bull market are not dependent on the politics and are a lot stronger, I think, than any one president.
If I am nervous about the election, what is my play? From a market perspective?
So my simplistic answer is the US is just so supersized and enormous that if the US doesn't work, there are very, very few places to hide. I can come up with one or two, maybe China's one, but there are very few places to hide. So if you're very bearish on the US, it's bonds or cash, frankly. But I don't think you should be that bearish on the US. I think the election is one of the ingredients of this wall of worry that I think the market is just going to keep climbing, along with inflation, along with recession fears, along with, tech bubble. I think we're going to get through it all. There's an element of truth in all of that, but not enough, I think, to derail this bull market. But I think the other one is that this bull market, I think, should broaden from here. It's been very much about the US exceptionalism, tech exceptionalism, and I think the story for the second half is that will necessarily broaden out, and the other assets which are more sensitive to rate cuts and a growth recovery, which is basically the rest of the world, I think should perform better. So Europe, emerging markets, sectors, real estate, financials. So I think tech will be fine. I think the US will be fine, but I think the leadership will broaden, and I think that will be very healthy.
Ben, there's nowhere else to go. So if the U.S. is still on the cusp of hell in a handbasket status, let's wipe that away. Any overseas markets, any emerging markets that investors who don't want to be in cash because it's trash, as the old saying would go, if they don't want to be in cash, is there somewhere else they could go?
So I think all of the above, quite frankly, because they all have a lot in common. They performed very resiliently, despite this sort of super dollar, despite higher for longer US rates. Traditionally, that would have been a catastrophe for all these other assets. So they performed very well, or better, resiliently. So I think that is an interesting signal. But the catalysts are still coming. I think when the US starts cutting interest rates, which I think gives the green light for these other parts of the world to continue to cut interest rates. We've had something like 70 rate cuts so far this year versus only 16 rate hikes. The US is right at the back end of that, but this global interest rate cycle has started and I think will accelerate. And the assets that are most sensitive to lower interest rates and stronger economies are in the rest of the world. It's not big tech. Big tech is just delivering regardless. I think it's Europe, it's emerging markets. This is where earnings are depressed. This is where valuations are depressed. This is where you've had literally 10 years, if not more, of underperformance. So by definition, these markets are under-owned. And then the icing on the cake here, and it goes back to what I was saying earlier, the US just being so supersized and these other assets being very small, even a little reallocation out of tech or the US goes a very, very long way in some of these other assets. So I'd be looking at Europe and I'd be looking at emerging markets. They're both tiny. They're both very sensitive to stronger growth, lower interest rates, and just a little bit more investor interest.
I can remember a day, Ben, and I imagine you could recall this too, when the U.S. wasn't working in terms of markets, meaning that U.S. stocks weren't doing that well, the first thought would be go to China. It was a growth market. It was a hot market. That was always the place to go if the U.S. wasn't working. But whoever wins the White House in November, they both have taken hawkish positions against China. What's your vibe on the China market? And is that dead money because of the rhetoric that has come out of the White House?
That was the narrative coming into this year, that China was uninvestable. You were coming off 2 years of declining Chinese stocks. And of course, whenever you hear that, the opposite tends to happen. So China has rebounded fairly strongly. Why? Because expectations were washed out, because valuations, you're on a single-digit price-earnings ratio, less than half the US. And interestingly, China has at least as many tech stocks, if not more, than the US does. So we're not comparing apples and oranges here. And, they have some policy flexibility and they're beginning to use that, maybe not as aggressively as we would like. But, China's never as bad as you think it is, or neither is it as good. So I think, China's not uninvestable. I think it's a very bottom-up market. It's a very big place. I think China's going to be fine. As I say, the fact that it's perceived as being uninvestable, the fact that it's very under-owned, may make it a little bit more defensive and a little bit less correlated if you do think the US market comes off hard here, which I don't think is the base case. But if you are looking for places to hide, China's one of those few places which is big enough, less correlated, and cheaper enough that may be an interesting place to hide if you are bearish on the US.
You mentioned rate cuts a moment ago. When does that first rate cut happen in the US based on your analysis? And then when that rate cut happens, do you think that is already priced into stocks here?
I think the rate cut will come. Well, first one will come in September, but I think big picture, I don't really care. as long as the next move is down. That I think is absolutely key. I think the market is happy to wait. And that's been the story this year. I mean, as you know, we came into this year expecting 6 or 7 cuts. Now we're expecting 2, and the market's up 15% and, annualizing at the strongest levels in 40 years. So the market's fine as long as the growth keeps delivering and the rate cuts are on the horizon. And I'm absolutely sort of in that camp. I think when that first cut does come, though, it's a big signaling event, especially for the rest of the world and for all these sort of non-tech, more interest rate sensitive assets, which I think will all breathe a huge sigh of relief and will rally very strongly. So I think the first rate cut is a big catalyst. It will really release the pressure valve, especially in the rest of the world, for a lot of these, and be the trigger, if you like, for this rally to begin to broaden out. I mean, this has been a real one-legged stool so far. 2/3 of your S&P 500 return in the first half of the year were from the Mag 7.
Ben,
that's great.
Yeah.
Yep.
Yeah. For those new investors watching or listening to this podcast, why are rate cuts so important to stocks and assets?
Well, 2 reasons. So one, I think it's a massive insurance policy for markets. If the rate cuts are coming, I think the economy is going to stabilize. Maybe we're going to get better growth in the future. It takes recession risk, I think, or reduces recession risk, and it boosts corporate earnings. That's one. The other one is I think it supports valuations. And there are only 2 ways to make money in stocks. Higher earnings and higher valuations. And I think rate cuts help both of those. That's why they're important.
All right, Ben, hang with us. We're going to go off for a quick break. Don't go anywhere. We'll be right back. So, Ben, thanks for hanging with us. We were really talking about the impact to stocks from interest rates or lower potential interest rates. And really, I would argue one of the biggest beneficiaries this year because of the potential for low rates has been tech. Sure, results have been very strong fundamentally. NVIDIA, Microsoft, Apple, Meta, you name it. All those results have been strong. But I think that sector has really benefited from the prospect of lower rates. But have we reached a point where tech stocks, some of these big tech stocks that have led the market, are nearing a peak? They just, from a valuation perspective, Ben, I'm sure you could appreciate this, to see NVIDIA priced at 22 times forward sales, almost 2 times Microsoft, most investors have never seen that type of valuation gap before.
Listen, I think tech is absolutely fine. This has been very fundamentally driven. You took at that long-term price chart of NVIDIA, it basically matches how earnings have risen. But I'm not going to argue that you're going to see the degree of performance going forward that you've just seen, right? NVIDIA is, close to being the biggest company in the world right now. We're really saying this is going to double again, which is what it's done this year. We're really saying this is going to be a $6 trillion, valuation stock in, a year's time. I don't think so. I think that tech earnings growth story will slow from here. But I think these valuations are very well supported, but I don't necessarily think they're going to go higher, which is why I think this bull market will broaden from here. You talked about, interest rate cuts. Yes, interest rate cuts will help tech, but they're going to help everybody else a lot more. Where valuations are a lot lower, where they're much more interest rate, where they're much more economically sensitive, and you're going to get much more bang for your buck, I think, in those other sectors as interest rates come down, as earnings firm up, and as valuations potentially move higher. So tech is fine, but I think the story for the second half of the year is going to be this delayed broadening of the bull market and this delayed rotation and change in leadership away from tech.
I keep looking for anecdotal signs of a peak in tech, Ben. And look, and we have calls now of NVIDIA potentially. Pundits are out there saying it's a potential $10 trillion market cap. You had NVIDIA's CEO, a month and a half ago, signing a woman's chest out there on a tour of the company's various products. Like, to me, this just seems like another bubble waiting to happen. I mean, does this feel like what happened in the late 1990s?
So I think the important thing to remember about the late 1990s was we were absolutely right on the tech adoption and the earnings story. What we got wrong was we just paid far too much money for it. So, Cisco's your NVIDIA equivalent. I think Cisco's sales are up 7 times since then. So, the internet adoption story all delivered, but we were paying 110 times price earnings ratio for Cisco at the peak back then. And therefore, Cisco's share price has never recovered. I think what's different this time round is Nvidia is less than half that valuation right now, and the earnings story is still, delivering. So, is this a bubble? No, not yet. Could it become one? Yeah, absolutely. So I think this rotation, I think you do it because I think of that sensitivity to rate cuts and these firming economies, but I also think you do it for sort of risk mitigation purposes as well. I believe in tech, but you're not going to have the degree of leadership and outperformance in the second half that you had in the first half of this year.
I'd love to get your thoughts on this one. We're awaking today that Roaring Kitty, Keith Gill, disclosed a 6.6% stake in Chewy. Now, Chewy is a real business, growing sales, making money. They're opening vet clinics. We've talked to the CEO, Sumit Singh, numerous times. This is a real company doing real things. So, I get it. But I can't help to think this is classic fear of missing out. And I think a lot of, the market's rise is now luring in more retail investors who see what a Keith Gill's doing. But also they feel like, Ben, they've missed out on something really, really big. They probably missed out on Nvidia's move for the past year and a half. I mean, what's the impact of FOMO or fear of missing out in the market here right now?
So I think FOMO is one of the two sort of technical supports you have for markets sort of here. So again, I think this is very fundamentally driven, right? Earnings are accelerating and rate cuts are coming. But if, we are overdue a pullback, right? We've had one pullback so far this year. Typically you see 3 a year. Your average intra-year S&P 500 drawdown is 14%. We've seen nothing close to that. So, we're going to get some volatility. We're going to get a pullback. So, the two things that help you there, one, we have record amounts of cash on the sidelines. And I think this is maybe less about retail investors that have sort of been structurally long tech for a long time here. I think it's more about everybody else. Institutional investors who are have been structurally underweight tech. We have $6.5 trillion in money market accounts right now, sort of all-time high. So, I think there is this sort of bubbling FOMO. I don't think it's extreme yet, but I think you get a pullback in markets. I think that money will come off the sidelines. A, and B, if it's more sinister, if we've got a jobs report coming up on on Friday, if the economy starts to stumble here, the Fed can easily cut interest rates pretty aggressively. So I think those are the two sort of supports to markets. But to your point, FOMO is absolutely one of them.
What is that trigger point, Ben, that would pop some of that FOMO? Is there a data point you're locking in on? Is it something like a Roaring Kitty going out there and buying some shares in Chewy, disclosing a 6.6% stake?
So I think the fundamental risk is that we get an inflation resurgence. That inflation hasn't really been put back, under control. As I say, markets are happy to wait for that first cut as long as they know it's coming. Markets are not ready for the Fed cycle not being done. So I think, that's your one fundamental risk. I think we're fine. I think the economy's cooling. I think there was a productivity boom going on, but, wouldn't be the first time I've been wrong. And I think
no, you're always right, Ben. You can't. No, you're always right. I mean, you're always right until you're proven wrong.
And I think the second one is just, we get this exuberance. Mm-hmm. We had a little bit of that, before the pullback in April, but I think we're a long way from that, right now. We haven't seen big inflows into, money market funds. Retail investor sentiment, is not off the charts, either. The VIX is pretty low. I mean, I guess that's the one indicator which is sort of flashing yellow. But FOMO, we're watching, but it's not there yet.
Where do you see? There's been some chatter recently over the past few weeks. I think it was ultimately triggered by Tom Lee over at FundStrat, really making an aggressive call on the S&P 500. Looking out over the next decade, where do you see some of these major indexes going, and what are the drivers?
Yeah, so I think we're in the early innings of a bull market, and your typical bull market is 5 years and 150%. So what are we?
5 years, 150%.
Yeah, that's your typical average bull market. So we're a quarter of the way through that right now. This may be a little bit less big, just because our starting point was just much, much higher. We never had that recession which crushed earnings. Valuations never got crushed down to 11, 12 times, which is historically what you've seen. So this may be a little bit smaller than that bull market. But, at this stage, who cares, right? We are in these sort of foothills of this. The earnings recovery story has barely begun. We might get to 10% earnings growth, in this coming quarter, which starts, next week. But I think we have further to go. And I think with the Fed about to cut interest rates, yeah, valuations are high, but 40% of your index is these tech stocks, which I think more than deserve these high valuations. And I think lower rates will support higher valuations for everybody else. So, I guess so longer term, don't bet against the US. Early innings of a bull market. Just this might be a slightly less big bull market than we've got used to historically.
So I did some quick math. So I'm trying to define a bull market. And so 5 years, if we're in the early innings, you think the S&P 500 could rise more than 100% over the next 5 years?
Yeah, that sounds about right to me. I mean, that's not too dramatic, right? Earnings could easily do compound out at 15% a year, I think, if the economy keeps, chugging along and you get a little bit of multiple expansion, which I think lower interest rates would justify. I think, the maths works, put it that way. The economy needs to play ball with that, but the maths works.
Ben, I think you just given me a case of FOMO. I don't know why I keep owning these CDs. I got to get the hell out of those things.
Ouch.
As you think about the rest of the year, what are some of your biggest fears about the market?
So overdue pullback. As I alluded to earlier, we are going through the sort of summer doldrums. We do have the election coming up. So I think that's a volatility event that you buy, that you don't sell, that, if you're bullish on markets, that you welcome because it lets you buy stocks cheaper. But that, easy for me to say, but when you're in the middle of it, a 5-10% drawdown, it obviously feels a bit scarier than that. I'm looking for those sort of tail risks that the Fed isn't done, which I don't think the market is pricing, which would force me to, reconsider my view. But again, I don't think that's happening. And, markets may well get ahead of themselves, which may well give you that, sort of short-term drawdown. But again, uncomfortable at the time, but that's sort of an opportunity. So that's what I'm watching. But again, I think this is a very fundamentally supported, market. Earnings are recovering, and rate cuts are coming. And if you don't believe me, look at what's going on in the rest of the world, where they've been going on for 6 months here.
In the remaining minute we have left, Ben, let me just go back. Maybe we could tie this in a knot here to the election. What president would be better for the market, Biden or Trump?
I think the market's already told you. It told you last week. It told you it's made its peace with Trump, and it thinks Trump, rightly or wrongly, is going to be better for this market.
Ben Laidler, really good to see you. Congrats on that new position. What will exactly you'll be doing there? What's your day-to-day look like?
I'll be doing equity strategy around the world. Obviously, a bit of a focus on emerging markets, given who we are. But again, given that the US is the big gorilla out there, I'll be doing a bit of everything.
All right, well, good to see you over there. Bradesco BBI's new head of equity strategy, Ben Laidler, really getting me excited about getting out of those CDs and getting into stocks. Potential S&P 500 up 100% over 5 years. I think I need to call my money manager. Ben Laidler, good to see you. Thank you for joining us on this latest episode of Opening Bid.
Thanks, Brian.